whatever this is, me talking into a phone while it moves around the universe. So sometimes I like to talk about things that have to do with some maths. One of those maths is the math of mean reversion. And you might ask me, what is mean reversion, Yasha? How does that have to do with marketing? Well, when it comes to everybody's favorite coin, Bitcoin, that is a volatile asset. And we know that returns on any asset mean revert. And what does that mean? Well, put simply, it means that when you have the mathematical mean of returns, right, which is a number that we can calculate, those returns, which are the log returns, those returns tend to mean revert. They don't just tend to, they do mean revert. And price action actually follows that. Returns do not follow the price action. Price action follows, if anything, the returns. Sometimes they're out of step for a wee bit, but eventually the price action will fall in line and will follow the returns. But it is in fact the returns that are leading the way by mean reverting. And how are the returns moving around the mean? Well, they're moving because of variance, which is the spread of data around the mean. And they're moving because of volatility, which is another way of saying the spread of data around the mean by saying standard deviation of log returns on investment, right? So standard deviation of returns is the volatility. Volatility is the variance. These things are very much the same. They're different and the same. They're like synonyms, right? They both mean the same thing, but they're pronounced differently. And they're measuring similar but different things. One is measuring the spread of data around the mean. One is measuring the standard deviation of returns. So, well, what does that mean that they're mean reverting? Well, that means that you have a mean line, a mean number, not even a line, just a number, and that mean moves up and that mean moves down. It doesn't matter if you see it in the shape of a line or just a dot. It really doesn't make a difference. That dot just goes up and down, up and down, up and down. Sometimes it stays in the same place for a little while until it moves away from there. But it always moves either up and down or stays in the same place. And what does that mean that the returns are mean reverting? Well, that means the returns of those means, as in the return on investment of those means, are either going up or down or sideways, right? And they are constantly zigzagging with the mean. In other words, they're constantly intersecting with the mean. And whenever they get to the mean, there's an extremely high probability that after it's done being on the mean, that it's going to go up or down. Because it either stays at the mean, which is not something it does for a long period of time usually, or it goes up or it goes down from the mean. And when it gets very far away from the mean, as in 1 or 2 or 3 standard deviations, sometimes more, away from the mean, it will tend to mean revert, because assets are only either moving away from the mean or mean reverting to the mean. Right? And you can use normal distribution models to figure out the standard deviations of how far away it is and what the probability is that it will start to mean revert. Or you can use Laplace distribution models, or you can use other distribution models if you really so choose. It just so happens that in trading volatile assets, Laplace distribution and normal distribution are two incredibly effective ways of measuring those distribution models for displacement from or movement away from the mean, and reversion to the mean. Anyway, thought I would just bring that up and explain to you why, if you look at something like the 4-hour time frame, ye old biddy, you'll notice that over the past few days, especially if you have access to the alpha trading RMLR and the alpha trading projection boss, and even the UPM with the power mean set. If you have certain settings set, if you know which ones to use, which you can find out for free in the alpha trading Discord, you'll see that there were a nice bunch of what are called intersects of the central power mean and the various RMLRs on Bitcoin, for example. And what that means is you were very likely going to have some nice movements, because it just so happens to be that given certain indicators like the RMLR and the projection boss and the UPM, when you have intersects, you tend to have time frame relevant nice size moves, meaning a move that is not the tiniest thing and is relatively nice given the time frame and the bigger picture. So it's not uncommon, for example, in Bitcoin to see a 1 or 2% move on a 4-hour time frame within a few candles of the intersect. Usually it happens between 0 and 4 candles. That's just how it happens. And you can have multiple intersects, one after the other, setting up a bigger move. And arguably, that is exactly what happened. If you look at the last number of days, you saw nice, tiny, relatively sized moves before the intersects. And then when the intersects started happening, the moves began to get a little bit more proportional to what we'd expect them to be. They still quite weren't there yet. They were doing all right, zigzagging back and forth very nicely. Not, they weren't super impressive to everybody. But then there were other time frames where there were also intersects, higher ones even. And then again on the 4-hour, after the buildup of multiple intersects, at a certain point, on exactly the right candle, when it was expected, boom, you had the beginning of a nice little pump. And we saw the price action go up something like 21% in 6 days. No leverage, nothing. Just good old-fashioned price increase on the asset. What does that mean? That means that the tools are phenomenal for trading, for finding and front-running trades, getting in early, getting out early with a nice profit in hand, and that you can tell very easily where the mean is and where the asset is in relation to the mean, and whether or not the returns are driving the price action away from the mean or mean reverting back towards the mean. And when I say back towards the mean, of course I mean mean reversion can happen up, down, or sideways. It can even happen in a continuation pattern, as we've seen so far this week, where the price on Bitcoin went up, sideways, up, sideways, up, sideways. It didn't come crashing right back down, but it is still mean reverting as the mean is rising, and as the reverse mean is rising. Right? The RMLRs are rising as well as the mean, and the projection bosses are showing the asset moving perfectly within the distribution models. So what does that mean? All of that. What is the point of all this? The point of all this is just to let you know that there are mathematical ways to find things that are useful as traders and as marketers. How do I bridge this divide between trading and marketing? How are they in any way related? Well, think about it. If you market orange coin products, if you market products that are bought and sold with orange coin, And by that I mean you have a store, a brand, and you enable customers to pay for it or for the stuff in your store using Orange Coin. Well, then you need to be aware of the ongoing current price of Orange Coin in terms of its dollar value or euro value or yen value or whatever value, right? If you're charging strictly in Orange Coin and you're only asking people to pay in Orange Coin, it may not matter to you if you're saying this costs 0.001 Orange Coin or this coin costs 0.03 Orange Coin or whatever, but it will probably very likely matter to the person who is paying you said Orange Coin, right? And that's why you should have something on your store or on your products that is aware of the price of that coin in relation to the others that your customers are likely to use to actually pay you. So, or at least that they're going to use to do the mathematical conversion so that they know the amount that they are going to pay you in the currency that they're usually transacting in. So yeah, while you may be marketing things strictly in Orange Coin, or maybe you're not, maybe you're like most people, you just accept it as one of many forms of currency, well, good for you. Remember, most people are still dealing with fiat, and so they want to deal with numbers that they comprehend since a long time. So they're not really interested in numbers that are strange to them and are confusing to them. They want something clear and easy, and they don't really care if the math on the asset is in mean reversion or not, right? What they care about is that they're getting a good fair price and a good fair value, or even a great value for a fair price. Ideally, they want the best possible price, but not always. In fact, depending on the item, sometimes price can be a factor in a very counterintuitive way. And that is to say, if you're selling a luxury good or a product of perceived luxury value, it can very often be the case that if you charge too little, people will not trust it. You have to have the sweet spot that people will actually believe that what you're selling is real and not just some gimmick. And believe you me, I know all about that because we, for years, have been, literally giving away free access to various tools and trials, free trials of the software that we make for alpha trading. And yet, for whatever reason, it's remarkably challenging for people to accept these free tools, which tell you these exact things. And I find that, could we change that? We could change that. How could we change that? Well, for one thing, we could charge more. That's a very easy and effective solution, right? But we don't want to. Why not? Well, because we don't believe that people should have to pay an arm and a leg just to get good information in order to trade. On the other hand, if we don't charge more, fewer people will be using them. Because again, more people will pay more because they'll perceive it to have a greater value. Even if we're telling them it is worth more, but we don't want to charge you a greater value. And you might ask yourself, why you charge a little then? Again, we don't want people to have to struggle or to even have to think about, is it worth this much money? We know it's worth this much money, right? Our community is made of actual traders, not people who just sit around and look at the charts. they actually use the maths indicators. Indicators at $2, $3, $4, $5 a month. Our suite is dozens of indicators, and with like 40 of them. I highly recommend taking a look. It's free, like I said. Because it's free, you probably won't take a look. Also, because this video doesn't have high video production value, you probably won't take a look. And those are all things you will miss out on because, and might I say, pretty badly for most of you. Not saying that to denigrate anybody, not saying that to disrespect a degen, and I actually am a profitable trader using my methods with traditional tools, etc. Congratulations. All right, this thing keeps going in and out. I wonder how many people are watching this at all. Probably. That's okay. Congratulations. Format. And there's still not running with it full speed, and that's okay. They've got themselves out of the trap of the ridiculous content that they use over there, where 99.5% of the time retail traders lose trades and eventually get liquidated. So yeah, I highly recommend trading what we call the VEPs, which stands for volatility, entropy, probability, and statistics. And